This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 28, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is sitting virtually flat at $739.09, but look closer. The Nasdaq is sliding, the energy sector is getting crushed, and a single tech stock has just wiped out billions in value overnight. We are on the edge of the FOMC, and the market's attempt to look calm is starting to crack. Ahead of the open, the calendar is dominated by one event, the Federal Reserve's policy decision tomorrow, July 29th. That is the primary driver for today's positioning. But before we get there, earnings are moving needles right now. IQVIA Holdings reported a strong beat this morning, jumping over 10%, while Corning took a massive hit, gapping down nearly 15%. And speaking of rates, AT&T is reporting today, serving as a critical test for rate-sensitive utility plays as the yield curve remains flat. Apex, what's the strategic takeaway from this lineup?
It's a stress test on the higher for longer narrative. IQVIA success suggests defensive healthcare can still command premium multiples, but Corning's collapse and AT&T's timing imply that industrial growth and debt-heavy balance sheets are facing immediate headwinds from sticky inflation and rigid monetary policy.
Let's look at the tape as it stands as of 16:35 ET on July 28, 2026. The S&P 500 ETF, SPY, is essentially unchanged at $739.09, up a mere plus 0.2%. But the Nasdaq QQQ is down minus 0.31% to $682.12. The Dow Diamonds is up plus 0.48% to $521.26, and the Russell 2000, IWM, is up plus 0.6% to $292.91. Sector-wise, it's a war zone. Staples, consumer staples, are up plus 1.46%. Healthcare, the healthcare sector, is up plus 0.51%, but energy, the energy sector, is down minus 2.11%, and technology, the technology sector, is down minus 0.9%. The VIX is lingering at 18.58, suggesting complacency despite the turmoil. Pulse, walk me through this dissonance. Why isn't the VIX reacting to the pain we're seeing in tech and energy? Three headlines are defining the pre-market mood. First, Corning, GLW, has gapped down 14.9% to $122, cited as a reaction to negative commentary, sparking a sector-wide scare. Second, IQVIA ICF is up 10.3% to $235.20 following a strong quarterly beat. Third, Amcor Technology, Amcor, is down 12.2% to $53.33, joining the tech sell-off. Pulse, let's start with you. How does the sentiment register on Corning's crash versus IQVIA rally? It's a textbook flight to safety, and frankly, it's eerie how quiet the broader market is. The VIX at 18.58 is completely detached from reality. You have GLW crashing 15% and Amcor dropping 12%, yet the options market isn't pricing in a systemic shock. Meanwhile, consumer staples, the stapler leader, is surging 1.46%. Retail and institutional money aren't panicking, they're hiding. They're moving from volatile tech and cyclical energy into food, pharma, and basic goods. The fear gauge isn't up because the sellers haven't hit the broad indices yet. They've concentrated their fire on specific supply chain nodes. CIPHER, from a fundamentals standpoint, is this Corning crash an isolated incident or a warning shot for the tech sector?
It's a warning shot, specifically for the industrial tech overlap. GLW isn't just a glass manufacturer, it's a proxy for display tech and automotive electronics. A 14.9% gap down on news might seem idiosyncratic, but look at the companion pieces. Amcor down 12.2% and MU down 5.9%. This is a synchronized unwinding of positions in the hardware supply chain. Compare that to IQVIA, which is up 10.3%. IQV represents clinical trials, a service business with recurring revenue immune to the same commodity shocks hitting GLW. The market is delinking growth from valuation. It's no longer rewarding growth, it's rewarding certainty.
And SPECTER, from a risk perspective, what does this separation between SPY's flatness and QQ's weakness signal?
It signals a widening credit and liquidity wedge. Look at the yield curve. The 10-year minus 2-year spread is flattened to just 0.34 percentage points. When yields flatten like that, high-duration assets like QQQ get punished first because their present value collapses. SPY is artificially buoyant because it's weighted heavily in defensive sectors like health, the healthcare sector, and utilities, which, ironically, are showing mixed results, with the utilities sector down 1.32%. The flat SPY is a mirage. It's being held up by staples while the engine room of the economy, energy and tech, is stalling out. The risk isn't just a drop, it's a liquidity vacuum in the tech names if that 10-year yield decides to move.
Let's drill down into the charts. SPY is holding at $739.09, right in a narrow band between the July 27 low of $735.87 and the 10-day low of $735.21. Meanwhile, QQQ has broken below its July 24 close of $684.23 and is testing the 10-day low of $675.95. Grid, what is the technical posture here? Is SPY building a base, or is it leaking?
It's neither a base nor a leak yet. It's a distribution pattern waiting to resolve. SPY is consolidating in a tight $735 to $740 band, but the key is the divergence. QQQ has already broken its short-term uptrend. Look at the 10-day range for QQQ. It went from $724.36 down to $675.95. We are currently at $682.12, which is dangerously close to the floor. If QQQ touches $675.95 and holds, we might see a relief bounce, but the structure is bearish. The path of least resistance for QQQ is downward until proven otherwise. For SPY, $735.21 is the line in the sand. If that breaks, we open up the gap to $730. But right now, SPY is just delaying the inevitable alignment with QQQ's weakness.
I'd agree with the distribution call, but don't forget the volume context. Broad market volume is subdued. That flat SPY isn't being bought aggressively. It's just lacking sellers at the moment. Once the FOMC news drops, that thin liquidity disappears, and that $735.21 support becomes paper thin.
Exactly, and notice the resistance. SPY faces overhead supply at $744.91, the July 27 open. There is zero momentum to break that today. Meanwhile, QQQ needs to reclaim $684.23 just to regain neutrality, and it's struggling to hold $682. So the technical picture is skewed hard to the left.
That brings us to the sector divergence. Consumer staples is the best performer today at plus 1.46% to $85.36. Meanwhile, the energy sector is the worst performer at minus 2.11% to $58.36, and the technology sector, tech, is down minus 0.9% to $174.30. CIPHER, fundamentally, what is driving this rotation out of energy and tech?
It's a defense of margins. Energy is suffering from demand concerns. We saw that minus 2.11% drop. When crude softens, energy stocks lose their inflation hedge status. Simultaneously, tech is getting hit by the rate sensitivity argument. As CIPHER mentioned earlier, the yield curve is flat. High-growth tech stocks require future earnings to discount back to today. When rates stay higher for longer, those future earnings become worth less. So you see capital fleeing both the commodity cycle, energy, and the discount rate cycle, tech, and flowing into. Wait, Pulse, you had a read on the sentiment side here regarding staples.
Right, and it's not just staples. Look at healthcare, the healthcare sector, up 0.51%, and industrials, the industrial sector, up 0.3%. Investors are moving into boring businesses. Staples don't care about interest rates. Energy doesn't necessarily need growth. It needs stability, which it's losing. So the sentiment is shifting from risk-on to survival mode. The VIX at 18.58 tells you the crowd thinks they're safe, but the money flow into consumer staples proves they're terrified of volatility. They want predictable cash flows right now.
And let's not ignore the trap in the utilities sector. Utilities are down 1.32% to $45.68. Usually, utilities act as a bond proxy alongside staples. The fact that the utilities sector is underperforming suggests that even the fixed income substitutes are being sold. This implies investors aren't just seeking safety, they are reducing overall duration exposure entirely. They're getting out of bonds likes, and growth. That is a very tight liquidity squeeze signature.
Let's isolate the biggest mover, Corning GLW. It's down 14.9% to $122 on pre-market volume, 1.6 times normal. Grid, from a technical standpoint, what does a 15% gap down look like in the short term?
It's a hole in the chart. GLW has shattered any recent support levels. The immediate overhang is massive. Normally you'd expect a mean reversion bounce off such a wide gap, but given the concurrent weakness in AMCR and MU, this isn't an isolated bounce opportunity. It's a breakdown. The chart structure for GLW is now looking for a new baseline. Until that gap fills or until the sector stabilizes, GLW is a seller's market. The volume of 1.6x normal indicates institutions are exiting, not absorbing. There is no bid at $122. The next support is largely undefined until you look at broader sector ETFs like the technology sector.
And fundamentally, this is a confidence crisis. A 15% drop on headlines suggests that the buy side has lost faith in management's guidance or the product pipeline. In a sector this sensitive to macro trends, that kind of volatility kills momentum. Now compare that to ICVIA, which jumped 10.3% on actual earnings per share beats. The market is punishing speculation and rewarding verified execution. GLW is being punished for uncertainty. IQV is rewarded for clarity.
Here's the risk. If GLW continues to slide, it drags the entire semiconductor and display index lower, which feeds back into the triple Q breakdown we discussed earlier. Grid, you mentioned triple Q is testing $675.95. If GLW keeps opening wider gaps, it acts as a weight on triple Q, potentially pushing that ETF below $675.95 faster than the fundamentals alone would dictate. It's a contagion effect.
Correct. It's accelerating the breakdown. The mechanical selling from GLW's gap forces algorithms to reduce triple Q exposure, triggering stop losses at $684.23 and then $675.95. It's a self-fulfilling technical downgrade.
On the flip side, let's look at the bright spot. ICVIA ICF, up 10.3% to $235.20 on a quarter two earnings beat. Grid, how does this stock behave technically compared to the tech sell-off?
IQV is showing relative strength. While triple Q is making lower lows, IQV is making higher highs. Technically, it's breaking out of a consolidation phase. It's currently at $235.20, which is approaching recent highs. Unlike GLW, which is selling off into support, IQV is buying into strength. The chart is clean. There are no gaping holes to fill. It's a pure trend-following setup.
The fundamentals support this. The plus 10.3% move is backed by an earnings per share beat above $3. In a market where margins are under siege in tech and energy, healthcare offers contract visibility. Clinical trial services are sticky. Companies don't cancel trials easily. So IQV provides revenue predictability that GLW simply does not have right now.
Sentimentally, this is the safe haven trade working perfectly. Traders who sold NVDA or MSFT are taking profits and parking them in IQV. It's a direct flow transfer. You have capital rotting out of high beta growth and into mid-healthcare cap services. It's the most efficient arbitrage in the market right now.
But be careful. IQV is a service company. If the broader economy slows down enough to trigger a recession, which the flat yield curve hints at, healthcare budgets can get cut. Hospitals might defer trials. IQV is strong now, but it's not immune to a general credit crunch. Don't confuse defensiveness with invincibility.
Finally, energy. The energy sector is down 2.11% to $58.36. Grid, is this a technical breakdown or just a sector rotation?
It's a breakdown. The energy sector has fallen below key moving averages we track, and the price action is establishing a lower high. At $58.36, it's testing immediate support. If it loses $58, we could see a slide toward $56. The chart is ugly. It's selling off on volume, which confirms institutional participation in the exit.
Again, it's the yield curve. Higher for longer rates hurt leveraged commodity players. Plus, global growth fears are tempering demand forecasts. It's a fundamental headwind reflected in the chart.
And remember, the energy sector is often a proxy for economic activity. When energy sells off like this, it's usually the first signal that the market expects slower GDP growth. Combined with the flat curve, this is a dual warning sign. Growth is slowing, and the cost of capital is staying high.
So, to tie this together, we have a market that looks flat on the surface but is deeply fractured underneath. SPY is holding at $739.09, but it's being propped up by staples and healthcare while tech and energy bleed out. Apex, give us the final strategic synthesis.
The data shows a clear flight to quality and certainty. Grid identified the technical breakdown in QQQ below $684.23, and CIPHER confirmed that the fundamental drivers for this are the flat yield curve and the rejection of speculative growth, GLW, in favor of contracted revenue, XLE. Pulse highlighted that this is a sentiment shift away from risk-on, evidenced by the surge in consumer staples despite a low VIX. SPECTER warned that the simultaneous weakness in utilities and energy suggests a broader reduction in duration exposure, meaning this isn't just a rotation, it's a de-risking event. The consensus is that SPY's $735.21 support is the last line of defense for the broad index, but the internal structure is already correcting. Watch QQQ's $675.95 level. If that fails, the technical damage becomes systemic.
Key takeaways for the session. First, the S&P 500 is masking severe internal divergence, with QQQ testing critical support at $675.95. Second, the market is rotating heavily into defensive staples and healthcare, rejecting high-beta tech and cyclical energy. Third, the FOMC decision tomorrow looms large, and the subdued VIX suggests the market is complacent heading into the announcement. Stay disciplined, monitor the $735.21 level in SPY and the $675.95 level in QQQ. Thanks for listening to ShadowQuant Equities Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.